Okay, in this video we're going to be looking at asymmetric information that occurs when the buyer has more information than the seller. And the three that we're going to look at are the health insurance market, the car insurance market, and employment market or in factor markets. So, moral hazard occurs when economic agents, so generally we're talking about people here, but it can also be businesses or the government, adjust their behaviour to one that is less efficient from society's point of view. Okay, so it can occur when we get health insurance, it can occur when we get a job, and it generally occurs when people change their behaviour as a result of getting insurance, as they are insured against the risk. So for example, once you get car insurance, you might not lock your car because you know that if someone steals something from your car, then they're the ones that the insurance company's going to cover you. In terms of driving, you might drive faster once you've got insurance because if you get into a crash, you know that you're covered. The problem with moral hazard, it leads to a change in incentives, so it changes your incentives because you no longer have to pay. It can often lead to an over-allocation of resources towards things like repairs, which decreases efficiency in the allocation of resources. It can also lead to higher prices, can reduce technical efficiency, and reduce society's living standards. But your definition is your most important thing, when economic agents adjust their behaviour to one that is less efficient from society's point of view. So let's take the market for health insurance. When a person takes out health insurance, they generally know more about the state of their health and probability of making a claim than the insurance company. That's the asymmetric information. They know more about their current health, and they also know more about how they're going to behave after they get the insurance. So the problem with insurance premiums is that all people pay a very similar price, and healthy people in effect are subsidising the unhealthy. This means that unhealthy behaviour of unhealthy people leads to healthy citizens having to pay higher premiums. So for example, I get health insurance, that provides an incentive for me to eat more junk food, to smoke, to drink more, and therefore, because of that, I'm more likely to make a claim, and because the insurance companies have to make money, they have to raise their premiums, and therefore, because the premiums are now higher, healthy citizens decide not to purchase insurance. If the market had full information about everyone, they could price people based on their risk. So healthy people would pay lower premiums, unhealthy people would pay higher premiums. It's a case, but in the real market, without government intervention, often unhealthy people will subsidise health insurance for unhealthy people. Some healthy citizens therefore choose not to purchase health insurance because the premiums are higher. That's the adverse selection. The adverse selection is not only that the insurance companies are giving too much insurance to unhealthy people or unsafe drivers, but also because the premiums get higher, healthy people or safe drivers are less likely to buy it. Therefore, they're not covered if they get sick or if they get into an accident, and that leads to an under-allocation of resources towards insurance from healthier people. Moral hazard in the banks. A recent example of moral hazard would be when the government came out and said that any bank that goes bankrupt, we're going to cover. If you go bankrupt, we're going to cover your losses to make sure that consumers don't suffer their savings getting wiped out. But the problem with that is that the banks then started acting in a riskier fashion and giving loans out to people that couldn't afford them because they knew that if they didn't pay them back, that the government would fund them. So they changed their behaviour in a way that was less efficient because the government had told them that they would save them in the event that they went bankrupt. This meant that banks had less incentives to get credit checks and creditworthiness, and therefore led to essentially the banks basically being too risky and making suboptimal choices. Car insurance is a great example. You'll generally talk about car insurance or health insurance when you do these types of questions, but car insurance is too expensive because risky drivers increase the premiums for safe drivers. People who know they have a higher risk of claiming than the average group are more likely to buy insurance, where those that have a lower risk or are less risky are likely not to bother because it's too expensive. In this case, premiums are set according to the average risk, which means that it's only a rational decision for risky drivers to bother getting the insurance. And the problem with that is that safe drivers are not covered when they get into accidents. So putting up the premium does not solve this problem, for as the premium rises, the insurance policy will become even more unattractive to the safe drivers, and therefore less good drivers will essentially be able to get access to car insurance or will want car insurance. So when a consumer purchases car insurance, what does the buyer know that the seller doesn't? They know how they are likely to drive in the future and how risky they are. Why does that lead to moral hazard? Well, because once insured, drivers know that they can drive in a riskier fashion and they're covered in the event of a crash. That could lead to more accidents, costing insurance companies millions and millions of dollars. So that's one reason why it's inefficient, because it can cause accidents. Another reason is that safe drivers Not only are they more likely to be in crashes, but car companies are likely to raise premiums to cover their costs, meaning unsafe drivers don't get insurance, therefore they're not covered. So they're the two inefficiencies. One, it causes more accidents, and two, it leads to safer drivers not getting access to insurance. Who is likely to purchase car insurance and who is unlikely to purchase car insurance? Only risky drivers are likely to pay for car insurance, as it's no longer financially worth it for safe drivers. Therefore, they're both selecting adversely because they're no longer covered in the event of a crash, which can reduce their material living standards. That's the adverse selection, the safe drivers not getting insurance because it's too costly. Which of the following is not an example of moral hazard? Okay, if you go through the examples, actually I'll go through this with you in class. Problems with asymmetric information, summing up from the last two videos. It leads to consumers adjusting their behaviour to one that is less efficient or favourable for society. So some problems with asymmetric information in general is it can lead to owners of good cars keeping them due to sceptical consumers. So you don't want to buy a new second-hand car, so you just keep your new car, you keep your existing car, which may not be in your best interest. Healthy people are charged too much or discouraged from purchasing health insurance. There's under-allocation of resources there. And consumers waste too much time when they're looking for things like car repairs because they know a lot of them will overcharge them. So this is probably the most important slide. What a general question is being able to explain what asymmetric information is and being able to link it to both moral hazard and adverse selection. So in the case of asymmetric information in the car insurance market, the asymmetric information is the fact that companies know less about the buyer, about how they're going to behave and how they're going to drive after they get insurance. That's the asymmetric information. The moral hazard is that drivers start to drive in a more risky fashion because they know that they're covered in the event of a crash and that harms efficiency. And finally, that can lead to adverse selection because safe drivers do not purchase car insurance because the premiums go up. It's the same with health insurance. Risky people claim, insurance premiums rise, and then healthy people don't buy insurance. That relationship between these three things is really important. So, explain the relationship between asymmetric information, adverse selection, and moral hazard, and why it leads to inefficient allocation of resources. The existence of asymmetric information can lead to the problems of adverse selection. This means that resources are allocated inefficiently because the consumer or the purchaser is unable to make an informed decision. And then provide an example of the link between asymmetric information and adverse selection. So, for example, in the market for used cars, the purchaser's inability to determine the full worth of the car may mean that sellers cannot extract the true value of the car. This is because some sellers are selling lemons that are not worth the selling price. So the adverse selection that occurs is one, that people buy dodgy second-hand cars, and two, as a result, very few good second-hand cars are made available because they can't get a fair price. This leads to inefficiency because those with second-hand cars may choose to hold on to them and drive them because they're scared of making another transaction, and people that are selling second-hand cars can't get a good fair price for their product. In other instances, asymmetric information can cause moral hazard. This occurs when the buyer has more information than the seller. So, for example, when you take out insurance, you're more likely to be unsafe. That can lead to them taking on more risks, which will increase the premiums, and therefore it's inefficient because safe drivers don't get car insurance. Just with this question, you could talk about it all in relation to the market where the buyer has more information than the seller. So you could define asymmetric information for one mark, explain how in the market for car insurance it leads to moral hazard because people drive in an unsafe way, and then link that to adverse selection and inefficiency because not only is there more accidents, but safe drivers are less likely to buy insurance, and therefore there's an under-allocation of resources towards safe people or healthy people buying insurance. Asymmetric information can also occur in factor markets. So in the workplace, those offering their services as workers know more about their skills and their habits compared to those hiring them. So employers can often make wrong decisions when hiring people, or that would be the adverse selection because they don't know enough about the employees. Also, employees who are not constantly monitored may decide to slack off. So the moral hazard may be that if you employ someone for a long period of time, they're on a fixed contract, they might not work as hard eventually because they know that they're getting their job regardless and their income regardless. So when an employer hires a new employee, it's generally the case that the employee will know more about their productivity and skills. Okay, the principal and agent problem is when employees, so it's related to employment contracts, when employees act inefficiently once they are hired because they know that their employer lacks information about their progress. That leads to them hiring the wrong people, And it can also lead to adverse selection because firms are reluctant to hire new people because they don't want people doing the same thing. And it's also a moral hazard because they're not acting in the way that's best for their employer. Thank you.